Well, welcome everybody. Thanks for joining us this afternoon and for another one of our episodes. We're doing this live again today, and I'm pretty excited about this particular episode because today we're going to be talking a lot about commercial real estate in particular. We're going to be talking about more about the financing of commercial real estate, and we've got a great guest speaker today joining us. Chase Allen with Canada ICI is here. So Chase is going to be telling us all about what he does and sharing his experience through the pandemic and what he sees going forward. So I'm excited to have him. Chase is the managing director with Canada ICI, and he oversees the Winnipeg office here, originating debt and equity opportunities throughout Canada with a current focus on the BC, Alberta, and Saskatchewan, as well as Manitoba marketplaces. Now, since joining Canada ICI in 2012, Chase has worked to structure financing for a variety of transactions spanning all asset classes. He has originated and funded over $3 billion in commercial mortgage transactions since joining, and including more than $900 million in fiscal 2019. So, man, Chase, those are some pretty big numbers. That's awesome. Thanks for joining us today. So, you know what? When we kick things off here, why don't we start by you telling us how you got into this business and tell us a little bit more about your background.
Well, I think, you hit the nail on the head. My wife, Holly, is an absolute angel. She's at home right now packing everything for our move. So that's kind of shows you how much she does for our family while I'm masquerading on Skype calls.
Yeah.
I think, first of all, we have a son, a 24-month-old Walker, and a new baby as of October 9th, Berkeley.
Yeah, congrats again.
Yeah, thank you. I think, honestly, I don't really have any great parenting advice. We're kind of just muddling our way through it, I think, like most people do. Right now, our bed is full of two children, so four of us.
Yeah.
So it's a bit, I wouldn't say we're necessarily model parents, but we're definitely trying our best. I think the biggest thing for me is the professional life and the industry that we're in can be quite stressful, full commission, a lot of deadlines that we have to meet right away. And the best thing for me is to be able to go home to a family that I know loves and cares about me. And I obviously feel the same way about them. And that's really what gets you through the day. And ultimately, they're the reason that we do all this anyways.
Yeah, that's awesome. I mean, really what I was looking for was parenting advice because I have a 3-month-old at home right now. So I was hoping you had the playbook. Yeah, fair enough. So we know. I gave some numbers at the beginning here, and I know you guys are running a great business. And 2020 has been a really interesting year in commercial real estate. And I know, we see that we get a lot of questions from our clients, and we know a lot of people would be negative on it generally, just thinking that hey, there's a pandemic. They're looking at downtown Winnipeg at Portage and Main, and the towers are fairly empty. And so all of that's leading to this negative sentiment on commercial real estate. But I know that your group has been extremely active this year as well. So what would you say is keeping you busy this year?
Yeah, so the numbers that you read at the beginning don't have our 2020 numbers, and our 2020 numbers are actually about 160% better than the numbers that you had said. So we're on pace to do, my partner and I, about $1.6 billion in financing this year. Most of that is through CMHC, so Canada Mortgage and Housing. It's the program that we generally finance apartments with, so multi-unit residential rental buildings. We do both term and construction debt on apartments, and then we also do a lot of industrial and much less this year retail and office. So really the story this year is beds and sheds. If anyone has ever listened to a commercial real estate podcast in the last 9 months, that you would have heard a million times. It's really apartment financing and industrial financing. I had 5 things come to my house today with Amazon.
Yeah.
So they were all stored in a building in Winnipeg. They all came from across the world in buildings, whether it's from Vancouver or Shanghai or wherever. And it's totally apparent that industrial space is super high in demand right now. And I think that apartments are very similar. Everybody has to have a place to live. If you're on lockdown, where are you going to go? You have to have a place to live. So I think that apartments are really the story of this year as well. And one small anecdote as to the reason why I believe is that, in this pandemic, there's been a lot of big story around mortgage deferrals. And I think that that's really scary for a lot of people. So I think going forward, renting, it was trending this way anyways, but I think renting is going to be seen as a less risky option.
Yeah.
Not that we're going to have another pandemic in the next 50, probably even 100 years.
Hope not. Yeah.
Who knows? Hope
Yeah.
not. But the fact is that people will remember this time. It will always be very recent in their memory. And I think that they're going to look for the easiest way to have flexibility, which is going to be an apartment rental versus owning a home. So I think that that's going to be a story going forward. And a lot of people, a lot of our clients do as well.
Yeah, I can agree with that too. I mean, we're certainly seeing that on our side of the in our industry, frankly, with clients we're working with, especially as they they get closer to retirement or they're in retirement and they just want to deal with like the either the costs or the work that comes with like owning a home, and so we're seeing
Yeah.
a lot of them defer to going to a rental property. I know a lot of people, especially in Winnipeg, are somewhat against it because they grew up their whole lives like wanting to own a house, and that's the way
Yeah.
they've been taught by their parents. But in a lot of cases, we're seeing the best financial cases to rent going forward. So that's not surprising to me at all.
Yeah, I think in the prairie cities, like I'm from Edmonton, right?
Yeah.
And now I'm in Winnipeg, the two cities I've ever lived in. But I think that in the Midwestern and prairie cities, they're smaller. Like it's a 30-minute commute to go to buy a house for the same price you'd buy a downtown condo.
Yeah.
In the bigger cities, and as our cities in the prairies grow, that's going to become less and less of an option. You're going to have to buy or you're going to have to rent closer to where you work and things like that. And just to highlight one of the things you mentioned earlier about a lot of your clients or just people in general saying, there's a lot of negativity out there. I just read a LinkedIn post by someone I really respect, Person Real Estate, the CEO of Kingset and John Love. And he highlighted there was Amazon signed a 100,000 square foot lease in downtown Toronto in an office building. I think it was yesterday, reported today. And he highlighted that and said, watch what tenants do, not what pundits say. And so I think that's a really important thing to keep in mind. I mean, you would probably see this in your public market expertise throughout the year as well.
Yeah.
Is that you can't be scared by a Globe and Mail article written by someone who probably doesn't really know a lot about the industry that they're actually covering. They're probably just throwing up a if it bleeds, it leads type of headline. And what you have to really watch is what are people actually doing on a day-to-day basis? And if you follow that, you're probably going to be closer to correct than if you just read a headline and got scared.
Yeah, I couldn't agree more. I mean, we obviously see that a lot in our business as well, and there's a lot of media coverage of the stock markets and different types of investment structures. So I couldn't agree with you more on the comment about pundits because there's so many different opinions out there, and we know that most of them aren't worth their weight. But
and with things like Twitter and all that stuff now, every single person has an opinion.
Yeah.
And you got to watch who you listen to.
Yeah. So I know you're a big real estate investor yourself, and I know you're doing a lot of financing for real estate investors as well, I'm sure. So where are you seeing the biggest opportunities when it comes to real estate right now across or real estate going forward?
Well, I've talked a lot about multifamily already, and I think that it's not that difficult to think that I'm going to be in a favor of multifamily investment and industrial investment.
Yeah.
My personal portfolio is a lot more heavy on the multifamily investment. I do think that the two markets that I'm investing in are Winnipeg, locally here in apartment buildings, and in Alberta, specifically in Edmonton.
Yeah.
You could probably think that's because I'm from both those, or I've lived in both those places. I understand those markets a little bit better, but I truly do see two different opportunities. And the opportunity in Winnipeg, even though a lot of people are a bit worried about the overbuilding in apartments here right now, I think that purchasing existing stock and renovating to a bit of a higher quality so you can get a higher rent and a better tenant, I think that's a really, really good strategy. You're buying at a really low price as compared to replacement costs. So you're buying at a price of, say, $100,000 a door. To build that same building, that same location today would be $250,000 a door. So the replacement cost difference is such a great amount that you can charge that much less in rent, thereby making your investment far less risky. And when you're buying existing, you can put CMHC financing on it, where I'm sure we'll get to in this conversation, is about 1.5% today. You can get longer amortizations at 40 years. So if you're buying at a 5 or a 5.5 cap, which is the way we value commercial real estate, which is basically just an inverse multiple, I don't have to get onto that here, but when you're buying at 5 or 5.5% and you're borrowing at 1.5%, that cap rate interest rate spread is such that you can make a really, really good return, both cash on cash, and then when you factor in amortization and principal pay down, your return on equity is going to be above 15, 18%. So that's what I see in Winnipeg is very stable. Just buying normal, typical apartments is probably going to be a good strategy. In Edmonton, it's a bit different. I think that Edmonton is oversold. I think it has been for a long time, probably because I started buying there in 2012, and I felt like it's been oversold since 2014.
Yeah.
But I do think that right now, I'm starting to see a lot of, I'll say, people that held on for a long, long time that are just tired of it. They're either a bit older or they're just tired of having a losing investment, so they're throwing the towel in. And I've seen in the last 3 months a number of deals cross my desk that are, quite frankly, I would have loved to buy those at these numbers even 8 years ago. And so, for example, we're seeing, I've got a building under contract there now. That's a 7% cap rate. I haven't seen a 7% cap rate on real expenses, like real CMHC underwritten expenses. I haven't seen that type of a cap rate in Edmonton ever in my entire career on an apartment building. So I think that Edmonton is a bit of a different story. It's a lot more risk. You're probably going to have to deal with some more anemic rental growth. You're probably not going to get a lot of rental growth there. But I think that you're buying for a good cap rate. You put some low interest rate money on there, and then over time, you'll do very well just on the straight cash on cash return. But if Alberta ever does come back, if anyone ever drives a car again or turns the lights on again in an office building, which I hope they do, if that ever comes back, I think that Alberta will be a really great story.
So would you say, if you had to choose one, multifamily or the sheds, as you put it, would you choose multifamily?
It depends on who you are as an investor. I think if you're one of two investors, you have less equity to put down. You have more options in multifamily from a financing perspective. And if you want less capital cost to keep the building up to snuff and re-tenant it and things like that, multifamily is good. Industrial is for people with bigger pockets because you don't get the level of financing. You're going to max out at 70, 75%, whereas with multifamily, you can get 85. So I think you need more money to put as a down payment. And then on top of that, if you ever do have a vacancy, you have to spend a lot more money in tenant inducements, commissions for realtors, things like that. You do have to renovate apartments when they become vacant, but it's a lot easier to throw an ad on Kijiji and get someone in there tomorrow.
Sure.
Industrial, you have more vacancy. If you ever have vacancy, it lingers longer. You have to spend more money to get tenants in there. So it depends on the investor. If you have $2 million, I think you're probably going to be fine in both. I would say right now, you're probably going to get some good cap rate compression, meaning the value is going to go up over time in industrial. But I do also think you'd get that in multifamily. So not a very good answer. Either one.
Very political, but no, that's great. I mean, because I think contrary to a lot of other like investment advisors or portfolio managers out there, I mean, I think there's this misconception in a lot of cases that we're against our clients owning real estate because aren't directly involved with it, but in our case that couldn't be further from the truth because I know that a lot of our clients like to have assets like real estate in their overall portfolio, and we just treat it like another asset class. So and depending on the client, like some will buy it directly, they'll buy direct buildings like what you're talking about, or sometimes we're buying it through REITs if they don't quite have the net worth to buy the building themselves. But I think it's a great asset class in virtually any portfolio, and so this is great. Now you mentioned we were talking about CMHC and got into rates a little bit, and I know from previous conversations that you don't have the crystal ball, or at least you don't turn it on for me when I ask the question, but. Interest rates is completely another area that we're watching, given all the money that's been injected into the economy recently. It's something that we're watching here. What are your thoughts on interest rates over the next few years? And I know that this is a bit of a crapshoot, but what are your thoughts on interest rates, and how does that relate to the real estate investors that you work with, or even yourself?
Yeah. Well, the first thing I'll say is if I had a crystal ball, I would not be talking to you or dealing with my clients. I'd be a billionaire and in Hawaii constantly. Which is something I find so funny. Everyone always asks your opinion, and it's like, look, if I'm a service provider to you, I don't have a crystal ball, because if I had it, I'd be rich and over here. So I think that I think a lot of people have tried to pick the way interest rates are going over for pretty much my entire career, because I've been doing this the whole time. and they've just done a bad job. I mean, John Love, who I mentioned earlier, who I very much admire, I saw him on a panel in 2013 or 2012, and he said, when someone asked him the same question, he's like, I've been telling people interest rates will be going up for the last 10 years, and I'm just going to stop because I'm always wrong. And I think that if someone, of his knowledge level can be proven wrong, it just means that like nobody truly knows where they're going. So I would like to say that in the long term, they're probably going to be a little bit higher than they are today. They are incredibly low. But for the short to medium term, the Bank of Canada has come out and said that they're not moving rates until 2023 or 2024. I believe the Fed is very similar. Canada and the US follow each other pretty closely.
Yeah.
So I think that for the next 3 to 4 years, I don't think that anyone has that much to worry about where interest rates are going, because with the amount of money that's come in the system through the government in order to fight the pandemic, and that's every single government across the world, if interest rates moved up in any massive way, that would be a problem of global proportions. So just from that macroeconomic view, you're like, they probably can't move. Now, if you would have told me 2 years ago that we'd be in the middle of a pandemic right now, I would have said, you're crazy.
Yeah.
So anything can absolutely happen. So some of the things that could move interest rates upward would be, the vaccine, I think, went into the first person in the world yesterday, a 91-year-old lady in Britain. I think in Canada, it's coming next week. If the vaccine eradicates COVID I'm not a science brain, you know what I mean? But when I say eradicate, it's probably not killing it, but you know what I'm saying? If it makes it a non-issue and we go back to full-blown economic recovery, I think that inflation could get crazy, and maybe interest rates start moving up a lot sooner than 2023, 2024. I don't really know of anything else that could move it, but I also don't have that crystal ball. So who really knows? To talk specifically about where interest rates are for asset classes today, they differ between apartments and I'll say conventional, which is conventional would be, industrial, office, retail, and conventional financing on apartments, and then CMHC financing on apartments. So those two different buckets, just to be, easy for this conversation. Conventional interest rates today on a 5-year term, probably 2.5% to 3.25%, depending on asset class, the borrower, location, tenant quality, that type of thing.
Sure.
CMHC is a additional security for the first mortgage lender. So you get the first mortgage as your security, plus the certificate of insurance, which is a government guarantee. That's only available in multifamily. Because of that additional guarantee from the government and additional insurance from the government, you get probably on a 5-year term 1.35 to 1.55%. So vastly lower than the conventional rate, about 100 basis points, which is pretty typical for the last 20-ish years. You have about 100 basis point savings by going with CMHC. Now, CMHC has some other costs and things like that with it, which I won't get into, but on the whole, you're buying that certificate of insurance for the entire amortization period of that loan. So you get 100 basis points better financing for the entire amortization of that loan. So that's a huge advantage. And then the other advantage of CMHC is you get higher leverage up to 85% of CMHC's value and longer amortization, 40 years, whereas conventional would be maxed typically at about 25 years. So that's where interest rates are today. Where are they going tomorrow? Specifically, I don't know. I think macroeconomically, looking at that big, 30,000 foot view, they're probably going to stay relatively stable for the next 2 to 3 years, subject to some massive crazy change. And then I think it would be reasonable to assume that they move upward from there. But I don't know.
I would get. I mean, you're talking some very low rates there. So I would guess that since rates are so low, I mean, this is almost free money that we're talking about here, and
Totally.
so that must have spurred a big boost of sales and investment this year. I would think so anyway.
You would think so, except that the pandemic was the other kind of yin to that yang, right? So. Yeah. I think from about March until August, pretty much nothing traded Canada-wide. And that's from assets like multifamily to industrial. There's a few larger portfolios, but I think that was actually just closings of stuff pre-COVID. So a lot of the transactional market just locked up. And you can ask any realtor on the market, they would say the same thing. Recently, that's unlocked a little bit, and there are some trades happening. But what we've seen in our business, and the reason our business has exploded this year, is exactly to your point, rates are lower. but no one's selling anything. They're all refinances.
Gotcha.
So
Yeah.
if you own an apartment building and you're borrowing money at 4% from the local credit union, but we can repay it with CMHC at 1.5%, even if you had to pay a huge payout penalty, it makes a ton of sense.
Right.
Also with that, if you have a $1 million mortgage on a $10 million building, you can pull out $5-6 million bucks and have it, quote unquote, free money to be able to put onto your balance sheet to either strengthen that balance sheet for any, future mishaps, or to get ready to buy stuff, which we were doing in the beginning of this year. A lot of our clients were kind of one of two minds. One, I want as much money as I can on my balance sheet to make sure that I can make it through any storm. So refinance my stuff, lower my cost of capital, make my balance sheet more fortified.
Yeah.
And the other was saying, give me as much money as I possibly can get so that I can scout for opportunities.
Yeah.
And so those are the two people that we were really working with. And either one, you're getting a great deal. But I think that what you're finding now after kind of August, September, there's a lot of trades happening now. A lot of people are back in the market looking for stuff. Those are the guys that have dry powder because of the refinances they've done, or just dry powder because they have it.
Yeah. So I would guess that if people haven't refied already this year, that opportunity is still around right now, just given that rates haven't moved a whole lot in the last little while. Is that fair to say? Yeah.
I would say so. Yeah.
Okay. Now, I love highlighting your story as well, because you're running the office here out of Winnipeg. I'm a homer. I love the Winnipeg stories, and I know you're from Edmonton originally, but you're an adopted Winnipegger now, running this office, and all the numbers I see are showing that you guys are killing it from Winnipeg, and you're killing not just the competition, but you're doing really well compared to other ICI offices across the country as well. Is that fair to say? Yeah. Which is great.
Yeah, I mean, obviously we have a lot of love for our ICI guys across the country, but yeah, we've done very well. We're very fortunate.
So where are you seeing most of the deal flow? Which geographic locations are you seeing most of the deals being done?
Well, to be honest, it's easiest to do deals in your home market. So we excuse me, we do most of the financing that we do. Let's just use 1.5 as the number that we'll do this year. I would say probably $850 to $1 billion of that will be done in Winnipeg. That's refinances, that's construction, whatever it may be. The rest of that is across the country, obviously. But I think the second market that we're most active in is Alberta in general, with a specific location in Edmonton. Mm-hmm. Again, the theme there. I'm from both those cities. I know people in both those markets. We've been able to grow clients there for the last 12 years, however long we've been doing this. So I think that's kind of the story there. However, what's been interesting for us is we made a strategic investment with one of our clients in the Lower Mainland about 3 years ago, my partner and I. And because of that, we've gone out there a lot more. We've gotten a lot of referrals from him. And so we've been able to grow our Lower Mainland portfolio a lot more aggressively than someone else in Winnipeg might be able to. And then we've also got a big number of files in the Okanagan. So we just completed some financing in Vernon. We just got paid out of one loan in Vernon, actually. And we just submitted to CMHC for a $50 million construction program in Kelowna just this morning. So we're growing that portfolio as well. And I went out there for a site tour in summer. I got on a plane in COVID. It wasn't that scary, but I did. And I went out there and, I had some wine tours on one end and wine tour on the other bookend. So it's nice to do business out there.
I was going to say, I don't feel bad for you having to go visit Kelowna and Vernon. I mean, we have clients out there as well. And unfortunately, I haven't been because of the pandemic recently, but I'm normally out there once or twice a year at least. And it's not a bad place to do business at all.
Not at all.
So, just dovetailing into 2021 then, where, it's just around the corner at this point. How are you feeling about business in 2021? Are you optimistic at this point?
Yeah, honestly, I don't think I've been more optimistic than any time in my career. And that's on a number of fronts. I mean, obviously our team here at Canada ICI is 9 people. In the Winnipeg office is 9 people. I think that a lot of the people that sit around this table with me would agree that we're all very optimistic about next year, mainly because of our volume coming through is really, really strong. And we've got a lot of new business that we've been able to garner because of that volume. That's going to be funding in 2021. In addition to that, we've got a lot of people who haven't refinanced yet, to your point, and will want to do that in 2021. And I think on the personal side, I haven't seen the types of opportunities I've seen in Edmonton recently that in my entire career. And I think that the vaccine, when that news came out, thankfully it was after the U.S. election, not to get political, but the news came out about the vaccine was such a relief, even though we're in a very difficult time right now, and we all have to do our part to stay social distance and all that stuff. It is a relief that there is some sort of a light at the end of the tunnel, and it's not a freight train. It looks like it's going to be something good. And I think if that comes in, Benjamin Tell at the Toronto Real Estate Forum that was just last week via Zoom, he had a phenomenal speech. He's always super, super interesting. And it was then released in a newsletter. And basically at the end of it, he said, there's $170 billion of savings that Canadians have in their bank accounts.
Yeah.
The reasons for that we don't have to get into, but obviously the CERB program and people not traveling, all that type of stuff. When people are comfortable to unleash that amount of money onto the system, we are going to see economic growth that we've never seen in our lifetimes. I made this analogy to my wife the other day, totally opinion, zero base in fact, but the 1918-1919 Spanish flu, obviously the latest pandemic we had. Right after that was the Roaring 20s. I have no idea why, who knows why, but maybe it was because of exactly the same reason. I know I, for one, have been cooped up in a condo for 9 months. I'm not allowed to see my family at Christmas, which has been devastating because normally we'd go back to Edmonton and Calgary. I told my family the other day, as soon as we all have vaccines and we can go somewhere, we're going somewhere for a month. And we're going to just blow all the money we've saved. We're going to spend it on travel. We're going to spend it on new stuff. We're going to buy new cars. All that stuff. It's all going to go back into the system. And quite frankly, I've never been more optimistic than I ever have been. And that's saying something because I'm pretty optimistic all the time.
No, but we've been talking about the same thing, though. I mean, I think you're right. People are just itching to do stuff, and then as Benjamin Tall said, there is a ton of money on the sidelines. We're seeing it in clients. We're seeing it with just out with the economic reports. And I agree with you. I think there is potential for this Roaring 20s, like 2.0 coming, and travel certainly. I mean, I just think about my own self. We haven't traveled since obviously before the pandemic, and it's something that we like to do. And a lot of our clients the same way, you're the same way. And so I see that, there's going to be a lot of spending going on. And it's crazy to think because, you go through a pandemic, but you'd think nobody has any money. But no, it's the exact opposite right now with all the programs that have happened and people just not being able to spend their money. So I can definitely see that coming along as well. And I agree with you. I have some optimism as well. I feel it might be a bit of a bumpy ride early on. We're not quite through all of the storm yet, but yeah, I think as we go through 2021, the further we go, things will start to alleviate even further. And even the NHL is apparently planning on coming back on January 13th or something. So we'll see how that goes up. So I like to close things off and just ask about any resources, books, podcasts, and stuff like that you're an avid fan of or you're currently listening to or reading right now. I think you're a pretty big book reader, if I'm not mistaken, too. I heard the other day from one of your colleagues that you try to read 50 books a year. I don't know if that's still true or not, but what are you reading right now? What are you reading? What are you listening to?
Yeah, well, I do read that much. I'm going to make a sin, according to Naval, who's one of my favorite people to listen to, and tell you how many books I've read. He says don't do that because you're basically just bragging. But anyways, I've read, which is kind of what I'm doing now, I guess. But yeah, I'm on my 54th book this year, nice. which is really good. I really, really enjoy reading. So does my wife. And I won't lie to you. I read a lot of fantasy too, which is a guilty pleasure. But I think Naval Ravikant, the guy I just mentioned, he's someone that I listen to as much as I possibly can. And he's got a new book out. So Naval Ravikant's Almanac, I think it's called. I just finished that. And that's really good. And he basically says, don't worry about what you read. Just read whatever it takes until you love reading. And that's kind of what I've done. And so I'm reading the fourth installment of Brandon Sanderson's Stormlight Archive right now, which is awesome.
Interesting.
And then I think one of the books that I just finished in the summer that is one of my favorites is called Mindset. It's by Carol Dweck, and it's about a fixed and a growth mindset, and how most of us have both, but it's a phenomenal way to kind of just reset and introspectively look at yourself and see how you can improve your outlook on whether it's life or work or a relationship, just by learning some of the pitfalls that you can fall into because of the not innate, that's not the right word, but just the default setting and your mindset that you have. So I think those are the 3 books. I am reading Barack Obama's book right now.
Oh, yeah.
And if he ever listens to this, which I highly doubt he will, I'm sorry about this, but man, is it ever boring. It's really, really difficult to get through. I'm only about a chapter or 2 in, but anyway, so wouldn't necessarily recommend that one. But Mindset for sure I recommend. On the podcast front, I listen to as much as I can when I run and things like that.
Yeah.
Shane Parrish and the Knowledge Project, it's phenomenal.
Yeah.
If you have one podcast you can listen to, I would say that would be the one. He's Canadian as well.
Yeah.
And then Sam Harris, I absolutely love Sam Harris, and he used to have a podcast called Waking Up, and it's now called Making Sense. Big on meditation, which I have really tried to make a part of my life, not successfully necessarily yet, but I'm trying. And his podcast is really great. And then actually another kind of guilty pleasure, but the All In podcast, which is Chamath Palihapitiya, which I think is, if he ever wrote a book, I'd buy 1 million copies. He's again, Sri Lankan born, but raised in Vancouver, billionaire investor now with, his Facebook employees, so on and so forth. Yeah. Him and about 3 other angel investors, they call themselves the Besties, and they release a podcast every Friday, and it's their opinion on what's going on in the U.S., because they all live in the U.S. They're all Silicon Valley investors. I think the amount of just like layman learning you can do just by listening to them jabber back and forth, it's phenomenal, and it's super, super entertaining. So those would be my 3 picks on the podcast too.
That's awesome. I'm a little disappointed because I was about to pick up Barack's new book, but I think I'll probably still pick it up. But it's disappointing.
You should. What I can tell you is I got it on Kindle. Yeah. Honestly, if I got it in real life, it would have to be this big, because it is like, I feel like I'm like just going through. I'm like, okay, like, don't get me wrong, it's interesting, but he's very just like me, way too wordy, too much detail. Don't need that stuff. And I'm reading, and then I look down at my percentage complete, and it's like 3%. I'm like, what? How big is this book?
There's nothing worse, because I read on Kindle all the time too. I prefer like my Kindle over like a hard book now, but there's nothing worse than when you're crushing through pages and you're only going up by a small percentage at a time.
Oh yeah, it's really, really disheartening. That is for sure.
That's great. Well, I think we'll leave it there. Chase, thanks so much for joining us today. This was really great, really insightful, and I know our guests and our clients and other contacts that are going to see this are going to really appreciate your insight on not just the real estate market, but also, you don't have the crystal ball, but on interest rates and your opinions there. So thanks so much for joining us. For everybody who wants to reach out and ask any questions, please reach out to us at www.endeavorwealth.ca. All of our contact information is there, and we'd be happy to chat with you more about what we discussed today and anything else related to your wealth management needs. So, Chase, thanks again. Appreciate it. And everybody else, thank you for joining us. Take care.
Thanks for having me.